Dell stock is down 12% this month, but zoom out and it's still up 276% in the last 5 years. So here's the question. Is Dell about to break out or break down? At $125 a share, Dell trades at 16 times earnings, with an $85 billion market cap. Last quarter, they pulled in a record $29.8 billion in revenue, up 19% year over year. And their infrastructure group alone grew 44%, setting new records. Sounds unstoppable, right? But here's what almost no one's talking about. Dell still carries a mountain of debt. If their AI bet doesn't generate enough cash flow, that legacy debt could crush flexibility and weigh on the stock. So what you're going to learn today in this video is simple. Can Dell's AI partnerships with companies like Nvidia, its edge cloud dominance, and its record revenue growth outweigh the balance sheet risk, or is this downside bigger than Wall Street admits? My name is Rick Orford. I've been trading since 1999, and I am not a financial advisor. That's a good thing. I don't sell hype. I break down the numbers so retail investors like you and me can make smarter, more confident decisions with our money. Dell Technologies is a global leader in technology with a portfolio spanning PCs, peripherals, servers, networking, and storage. Dell is helping organizations adapt and drive stronger outcomes. By combining edge, core, and cloud infrastructure, Dell is at the forefront of AI, software-defined and cloud-native innovation. Today, Dell operates in more than 170 countries, supported by a world-class organization spanning R&D, marketing, sales, services, and financing. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. And you all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by almost 6 times. Go to fool.com/RickO to get your 10 stock picks right now. With a powerful sales force, global partner network, extensive service footprint, and a highly agile supply chain, Dell delivers end-to-end solutions at scale while maintaining deep customer relationships worldwide. And here's why this matters. Global reach plus cutting-edge infrastructure means Dell isn't just selling hardware. It's building the backbone for AI and cloud adoption. And that's where things really start to get interesting. So we can't talk about the stock without starting with the stock price, because that's why you're here, right? Feel free to scan this QR code to follow along. Today, Dell trades around $125.04 a share, almost 16 times earnings. And at that price, its market cap is about $85 billion. The stock traded between $66.25 and $147.66 in the last 52 weeks. And here's the kicker. The stock is down almost 12% this month. But if you zoom out, the story flips. Year to date, it's up 8.5%. Over the last year, it's up almost 11.5%. And if you bought Dell 5 years ago, then you would have nearly tripled your money, a 276% gain. So it goes without saying, time in the market beats timing the market. And that's the kind of compounding that retail investors can only dream about. But past performance doesn't explain the future. So let's ask ourselves, why has the stock done so well? For the second quarter, Dell reported record revenue of $29.8 billion, representing a 19% year-over-year increase. If we break it down, Dell's Infrastructure Solutions Group reported $16.8 billion in revenue, up 44% year-over-year, a new record actually. Meanwhile, the Client Solutions Group brought in $12.5 billion in revenue. In terms of net income, Dell grew its bottom line almost 38%, from $846 million to $1.16 billion over the same period of last year. So you could say that Dell isn't just growing, it's scaling up profitably, and that is a rare combo in technology. Management also updated their guidance for both the third quarter and the full year 2025, or full year of 2025, which is fiscal 2026. For the third quarter, they expect revenue between $26.5 and $27.5 billion, which would be up about 11% year over year. For the full year, management expects revenue to come in between $105 and $109 billion. And that'll be up about 12.5% higher than last year. Translation, Dell thinks the growth story has legs and they're putting their numbers behind it. But here's where things start to get interesting. The catalysts. Financials tell us where the stock is today. Catalysts tell us where it can go. For Dell, they're driving growth through innovations that modernize data centers, strengthen cyber resiliency, and automate cloud and edge operations. Its Power Protect and Power Scale deliver faster restores, lower costs, and advanced ransomware defense. With Dell Private Cloud, organizations can deploy and scale private clouds 90% faster, supported by full life-scale management and multi-vendor flexibility. Meanwhile, Native Edge expands Dell's reach into edge environments, offering cost-effective virtualization and seamless integration within legacy systems. The point is, Dell isn't just keeping up, it's trying to set the pace. Dell is also pushing forward with new innovations across Dell AI Factory with Nvidia to accelerate enterprise adoption of AI. This combines infrastructure, software, and managed services into a complete end-to-end platform, which helps businesses move faster from AI experimentation to full-scale implementation and deployment. And here's the insight I think most investors are missing out. The partnership isn't just about AI hype. It's about Dell embedding itself into the entire enterprise AI workflow. These advancements and the company's continued modernization efforts position Dell as a critical player in AI. But let's pump the brakes for a second, right? Because no growth story comes without risk. Dell operates in a market defined by rapid technological change, from PCs to AI-optimized infrastructure. Competitors can launch lower cost or more advanced offerings, chipping away at Dell's market share. If Dell falls behind, margins and growth could be compromised. Dell also relies heavily on single-source suppliers and contract manufacturers concentrated in Asia. Any disruption, from raw material shortages to geopolitical instability, could delay shipments, raise costs, or even limit product availability. With minimal inventory buffers, even brief interruptions can hit profitability hard. Also, as Dell dives deeper into AI, it faces increased exposure to cyber attacks and regulatory scrutiny. Security breaches could undermine trust, disrupt operations, and trigger legal or even compliance costs. And then we have evolving AI governance frameworks, right? Worldwide. They all add uncertainty, and one country's rules may not match another's, and oftentimes they don't. Lastly, we need to address Dell's negative debt-to-equity ratio. A negative debt-to-equity ratio means total liabilities exceed total assets. Translation, a higher risk of bankruptcy. This all stems from Dell's 2016 $67 billion EMC acquisition, which brought VMware under its umbrella through a leveraged buyout, meaning Dell used debt to buy EMC. Fast forward to 2022, and Dell spun off its entire ownership stake in VMware, making both separate publicly traded companies. Dell received a special cash dividend of about $9.3 billion from VMware as part of the deal, which it used to pay down debt. That's good. But Dell still maintains a negative debt-to-equity ratio. The problem? If Dell's AI push fails to generate enough cash flow, that legacy debt from the EMC buyout will continue to weigh on the balance sheet, limiting flexibility and increasing long-term risk. So while Dell is winning the growth race, its balance sheet is still running uphill. So with all that out of the way, is Dell stock a buy? And if so, who's it for? Well, a consensus among 20 analysts rate Dell stock a moderate buy, with a high target price of $167, suggesting as much as 34% upside from its latest close. The average score is 4.3, though it has been trending down over the last 3 months. And I tend to agree. Dell's innovations and modernization efforts may well position it among the top AI contenders in a few years. While Dell's liabilities may look concerning, the company does appear to be managing them well. The fact that it can manage debt and still report net income on its bottom line is ultimately what demonstrates stability. So the question I have for you today is, do you believe that Dell's AI has a future? Let me know in the comments below. And while you're there, if you found this video helpful, like and subscribe so others can find it as well. That's it for me today. Thank you so much for watching, and I'll see you next time.